We all just assume the numbers in financial reports are true, right? I mean, they're the bedrock of our whole economy. But what if they're not? What if that trust is built on a total lie? That's what we're diving into today, the insane price of financial deception.
And yeah, this goes way beyond just math. We're talking about trust, stability, the stuff that holds everything together. And when that trust shatters, the real world impact can be absolutely devastating. So let's unpack this whole story. What really happens when the numbers lie? Okay, so to really get a grip on the stakes here, we've got to go back in time. We need to look at a moment that didn't just shake the financial world, it completely shattered it. It kicked off this massive crisis of confidence. Picture this. It's 2001. Enron, this absolute giant in the corporate world, just collapses out of nowhere. And the reason? Well, it turns out their massive success was a total house of cards, propped up by cooked books and tons of hidden debt. The second the truth came out, the whole thing just imploded. People's savings, their pensions, gone. Almost overnight. And the fallout, man, it was like a domino effect. First, you had these catastrophic losses for investors. We're talking people's life savings just vanishing into thin air. Then, of course, the lawsuits in legal battles for the people responsible. But it didn't stop there. The damage spread, creating this massive instability in the market that rippled out and affected pretty much everyone. And, of course, it led to the company's own bankruptcy. So we've seen just how devastating the effects of a collapse like this can be. Now, let's get to the heart of it. Let's talk about the cause. What does it actually mean when we say a company is cooking the books? Okay, so at its very core, unethical accounting is all about intentionally messing with the financial records. We're not talking about a simple mistake or a typo here. No, this is deliberate deception. It's aimed at tricking everyone, investors, employees, you name it, all just to paint this fake, rosy picture of how well the company is doing. So you're probably wondering, how do they even do it? Well, there are a few classic moves. Companies might literally invent sales out of thin air to falsify their revenue. Or they can hide massive amounts of debt by concealing liabilities. Another trick is to just overstate how much their assets are worth. You put it all together, and you've got this really complex and ultimately super fragile web of lies. All right, so we've spent some time in the dark side of financial reporting. Let's flip the script. Let's talk about the ideal, the gold standard that the entire financial world is supposed to be built on. And that's the principle of honesty. You see, ethical reporting is so much more than just ticking boxes and following a rule book. It's a deep, fundamental commitment to showing the true and fair picture of a business. And to do that, you need two key things: transparency, which means being totally open with information, and accountability, which means taking full responsibility for those numbers. And when you put these two paths side by side, the contrast is just stark. I mean, look at it. The path of deception, it starts with concealment, leads to scandals, and ends in instability. But the path of truth, that's how you build trust, credibility, and something way more valuable in the long run, sustainability. One road leads to a complete collapse, and the other, well, that one leads to lasting success. Okay, so a crisis on the scale of Enron, you just can't ignore something like that. It was a wake-up call that demanded a really powerful response. Something had to be done to forge a whole new set of rules and regulations to make sure this could never happen again. Now, the foundation for all of this stuff lies in professional codes of conduct. And listen, these aren't just, polite suggestions. They are serious, rigorous standards set by major organizations around the world. Accountants literally swear to uphold these codes. Think of them as the official rulebook for financial integrity. But here's the thing, as Enron painfully proved, sometimes professional codes just aren't enough. The scandal was so massive, so profound, that it actually triggered a landmark piece of federal legislation. The idea was to put the full force of the law behind these ethical standards, to add another layer of protection. And that legislation was the Sarbanes-Oxley Act, better known as SOX. This thing was a game changer. It totally changed the financial landscape because it put personal, legal responsibility for the financial reports squarely on the shoulders of the top executives. And it also created way stricter oversight for the auditors who are supposed to be checking their work. So, a crisis happened, new rules were written, case closed, right? Well, not exactly. You have to ask, why does a story from over 20 years ago still matter so much today? It's because the lessons we learned from that crisis established these three absolutely essential pillars for any healthy company. We're talking about transparency, accountability, and fairness. And look, this isn't just corporate buzzword bingo. This is the literal bedrock of a healthy market. It's what allows a company to do more than just survive. It's what allows them to thrive for the long haul by earning and keeping the trust of everyone, from investors to customers. And think about it. For more than 20 years since SOX was passed, its impact has been huge. I mean, global companies have poured billions into strengthening their compliance systems. It's created this permanent shift towards more integrity and more oversight in the financial world. And it was all driven by the memory of that one single catastrophic crisis.
Which, leaves us with one final, really crucial question. We have stricter laws now. We have stronger codes of conduct, for sure. But when you boil it all down, the entire system still relies on the integrity of individuals. The rules give us a framework, but the real protection, that comes from the vigilance of regulators, of investors, and even of insiders. So, what's really stopping the next big one from happening tomorrow?